Oil prices near wartime levels, 30-year Treasury yield above 5%, and yet headline equity indices are still grinding higher. That clash between resilient risk assets and tightening macro conditions is setting the tone today. Welcome to vTalkInsight, Allocator's Lens Daily for May 6, 2026. Let's start with what this evolving backdrop means for equities. U.S. equities continue to look resilient on the surface, largely because the earnings machine is still running hot. For the S&P 500, first quarter profit growth is tracking around the mid-teens, with more than 4 in 5 companies beating expectations, which goes a long way to justifying recent gains. Tech and AI remain the epicenter of that strength. We see it in better-than-expected results from names like Pinterest, and in megacaps such as Alphabet and Meta pushing ahead with multi-billion-dollar data center programs financed in part through sizable bond deals. Behind the quarterly beats sits a much larger structural story. Moody's now expects over $3 trillion of global data center investment in the next 5 years, one of the biggest infrastructure build-outs in decades, driven by AI and hyperscaler demand. That spend is spilling over into industrials and communications equipment as well, from Prysmian's plans to expand U.S. cable capacity and optical fiber output by up to 50%, to semiconductor and hardware supply chains that are being rewired by companies like Apple, which is exploring new chip manufacturing partnerships in the U.S. Under the index level, however, the picture is much less comfortable. The equal-weighted S&P has fallen in most of the last 10 sessions, telling us leadership is narrow and concentrated in a handful of AI and platform names. In Europe, energy stocks are now leading sector performance on the back of higher oil, while travel and leisure names lag as fuel costs bite. Banks are also splitting, with UniCredit rallying on record profits and cross-border merger plans, even as HSBC drops sharply after a fraud-linked charge and higher loan loss allowances tied to a weaker outlook. Geopolitics remains the main external threat to this equity story. Persistent tensions around Iran and the Strait of Hormuz keep the risk of an oil spike, and with it downside risk to global growth, firmly on the table, with Europe looking especially exposed given its energy dependence and vulnerability to renewed U.S.-European trade frictions. On the policy side, the pendulum is swinging toward heavier AI oversight, from potential U.S. executive orders vetting new models to European and Chinese moves to ring-fence domestic champions. That could entrench the current winners, but also raises headline and regulatory risk, just as valuations in the AI complex are most stretched. With the S&P still rising and volatility gauges sitting in the high teens, allocators are navigating a backdrop where equity prices reflect strong earnings and optimism on AI, while underlying breadth, regulation, and geopolitics argue for greater caution. That tension is even more visible when we move over to rates. In rates, the focal point is the long end of the U.S. curve, where 30-year Treasury yields have pushed above 5%, and the 10-year is approaching 4.5%. That level on the 30-year has historically drawn in long-term buyers, but this time it comes against a backdrop of renewed inflation anxiety and heavy supply. Higher oil prices, driven by Middle East tensions, are feeding into inflation expectations, while robust U.S. growth, helped by AI-related sectors, makes it harder for the Federal Reserve to signal an early easing path. Market pricing now reflects a much later start to any cutting cycle, and in fact assigns a material probability to another Fed hike by 2027. Fed officials acknowledge that the Iran conflict and mixed labor data have raised the risks around both inflation and employment, but they still describe the current stance as broadly appropriate for now. The result is a bond market that offers much more attractive income than in recent years, but also exhibits sharper price swings, especially at the long end, reducing the reliability of duration as a portfolio hedge. Across the Atlantic, markets are leaning heavily toward further tightening by the European Central Bank and the Bank of England, even as growth headwinds build. Some analysts argue that hike expectations for both central banks are now excessive, with European government bonds in the 5-year area looking undervalued relative to the deteriorating outlook. In the UK, expectations have swung in a short time from multiple cuts to nearly 3 hikes as inflation and geopolitical worries resurfaced. Yield volatility is concentrated at the front end, while longer gilts are more stable, and some see scope for yields to drift lower over the next year if stagflation risks and labor softness push the Bank of England toward pause. Elsewhere, the Reserve Bank of Australia has delivered a third consecutive hike to about 4.35%, underscoring policy divergence, but also reflecting local dynamics that may not map cleanly to other economies. What is more general is the way higher energy costs and AI-driven capital expenditure are keeping near-term inflation pressures elevated. For allocators, that leaves government bonds in an awkward middle ground. Yields are finally high enough to be interesting on carry, but correlation with risk assets is less reliably negative, especially if another yield spike, rather than a growth scare, is what ultimately forces the next regime change. That brings us naturally to credit, where both public and private markets are adjusting to this higher rate world. Credit markets still look relatively calm on the surface, but beneath that calm the stories are diverging, particularly in banking. UniCredit has delivered record profits, driven by strong fee income, and is using that strength to pursue cross-border consolidation plans in Europe. In contrast, HSBC has reported a sizable fraud-related charge and raised provisions against a worsening macro backdrop tied partly to Middle East tensions. Its shares have sold off sharply, reminding investors that idiosyncratic risks and governance surprises can still bite, even without a systemic banking crisis. More broadly, European banks are flagging increased risks from geopolitical instability and slowing growth, leading to a more cautious tone on credit even as capital positions remain sound. UBS, for example, may gain some breathing room if Swiss capital rules are delayed or softened, but that also extends regulatory uncertainty for the sector. Defense and energy exposures intertwine with bank loan books, and with European industrials and exporters under pressure from higher energy costs and trade tensions, the scope for negative credit migration is edging higher. In parallel, private credit continues to expand, helped by regulatory openness in Europe and substantial capital needs in areas such as defense, sustainability, and innovation. Retail participation has grown rapidly, with hundreds of billions of dollars flowing into the space over the last 5 years. So far, credit performance has held up. Troubled borrower rates are around 0.5% in perpetual non-traded business development companies and about 2% in falling in listed vehicles. Yet U.S. regulators at the SEC, Treasury, and the Fed are now openly probing the sector for fraud and systemic vulnerabilities, and international investors are becoming more sensitive to negative headlines. Concentration is another theme to watch, as BDCs on average hold roughly a quarter of their portfolios in software, tying them closely to one sector's fortunes. On the positive side, AI infrastructure financings are increasingly coming to market as investment-grade transactions, with major tech firms absorbing more risk so as not to overwhelm high-yield markets. Overall, credit still offers carry and targeted opportunities, but it is increasingly being shaped by a handful of powerful structural themes: AI, energy security, and regulatory scrutiny. That backdrop is also feeding directly into currency dynamics. In foreign exchange, the U.S. dollar remains the primary shock absorber. Persistent tension in the Middle East and uncertainty over shipping routes are keeping safe haven demand elevated, and market participants are reluctant to run large short positions in the dollar despite high U.S. yields. Interestingly, the usual tight link between U.S. rate moves and the dollar has weakened since the latest round of conflict, suggesting that flows are now being driven as much by geopolitical risk and funding needs as by pure interest rate differentials. The euro is feeling the strain of Europe's energy dependence and rising stagflation risk. Rate hikes from the ECB, which might normally support the currency, are instead being interpreted as a drag on already fragile growth, leading markets to view additional tightening as euro negative. At the same time, Europe's slow progress on a digital euro and its heavy reliance on non-European payment infrastructure leave it strategically dependent on dollar-based systems. Dollar-backed stablecoins now account for the overwhelming majority of issuance, reinforcing the greenback's structural dominance, even as policymakers talk about diversification. Sterling faces its own challenges. UK political uncertainty and election risk are back in focus, and positioning is no longer as defensively short as it was during the last budget scare, which makes the currency more vulnerable to negative surprises. Short-dated UK rates have repriced violently from expected cuts to the prospect of multiple hikes, adding to currency volatility. Yet those higher yields are not a straightforward positive because they come alongside concerns about growth inflation persistence, and financial stability. The Japanese yen remains under pressure as long as the Bank of Japan avoids a sustained hiking cycle. One-off FX interventions can slow moves, but without a shift in the policy rate path, upward pressure on dollar-yen is likely to persist. The Australian dollar, meanwhile, initially rallied after the Reserve Bank's latest hike before retracing as the bank signaled a potential pause, underlining how sensitive currencies are to nuances in policy communication. Taken together, FX markets are reinforcing the message from other asset classes. In a world of elevated geopolitical risk, the dollar is still the anchor, while Europe and Japan look more fragile. Commodities, and oil in particular, remain the macro hinge tying these narratives together. Renewed hostilities in and around the Strait of Hormuz, including missile and drone attacks on vessels and energy infrastructure, have forced significant rerouting of shipping traffic. Roughly half of vessels in the Persian Gulf have shifted closer to Dubai and away from the strait, and although U.S. naval escorts have so far managed to keep some flows moving, the underlying standoff between the U.S. and Iran remains unresolved, keeping geopolitical risk premiums elevated. On the supply side, production in Kuwait and Saudi Arabia has been constrained by logistics and storage, while attacks on UAE infrastructure add another layer of uncertainty. Inventories of key refined products such as naphtha, jet fuel, and LPG are drawing down rapidly, and global jet fuel exports have fallen sharply, already forcing airlines to cancel flights. The U.S. is exporting more refined products to plug gaps in Europe, Africa, and Asia, which supports global supply, but also raises domestic fuel prices. If sustained, this combination of high prices and patchy availability points to further demand destruction and pressure on energy-intensive sectors. Oil benchmarks are holding at elevated, near wartime levels, with some gauges still above $100 a barrel despite a recent pullback. Pricing still implies some expectation that tensions will eventually ease, but the risk is skewed toward another leg higher if the ceasefire fully breaks down or infrastructure damage escalates. Such a move would not only boost headline inflation, but could also unanchor inflation expectations, push long-term yields even higher and weigh on global equities, with Europe and energy importing emerging markets looking most at risk. Set against this acute shock are structural shifts in energy demand. Bioenergy, especially ethanol, is seeing robust growth as countries look to reduce reliance on fossil fuels, while companies tied to electrification and data connectivity, such as cable manufacturers and grid equipment suppliers, are investing heavily to meet surging AI and digital infrastructure needs. These trends support long-term demand for a different mix of commodities, even as the near-term story is dominated by crude and refined products. For multi-asset allocators, the key is that what happens in energy markets over the coming months will feed directly into inflation, yields, FX, and sector earnings, making commodities the fulcrum of the current regime. Pulling it all together, the cross-asset picture today is one of powerful structural tailwinds colliding with acute macro shocks. Equities are being carried by strong earnings and an extraordinary wave of AI and data center investment. But leadership is narrow and increasingly exposed to regulation, higher rates, and geopolitics. In rates, long-dated government bonds now offer meaningful income, yet their diversification value is weakened by the same energy-driven inflation pressures that are pushing yields higher. Credit still looks orderly, with robust demand for high-quality and AI-linked issuance. But bank-specific surprises and the rapid scaling of private credit argue for closer attention to underlying risks. FX markets are broadcasting a clear message. The dollar remains the preferred refuge, while the euro, sterling, and yen are all grappling with their own combinations of energy, growth, and policy uncertainty. Commodities, anchored by oil and refined products, sit at the center of the macro story, with developments in the Strait of Hormuz and global product markets likely to shape inflation and volatility across assets. For allocators, the coming weeks will hinge on whether energy tensions ease, allowing earnings and AI to stay in the driver's seat, or whether a renewed oil and rate shock forces a broader repricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.